Welcome back to the deep dive. Today we're looking into Trimble Inc., ticker TRMB. They're this really interesting industrial tech company trying to connect, the physical world, construction, farming, logistics, with the digital side, software, AI.
Exactly. And our mission really is to figure out if this big digital transformation they've been talking about has actually built them a real competitive edge, something durable.
Or is the market maybe still seeing them deep down as just a hardware company that goes up and down with the economy?
That's the core tension. Are they becoming this essential digital ecosystem people can't leave? Or are they still, vulnerable to those big swings in equipment buying? The stock price kind of suggests the market thinks they've already cracked it.
Right. Okay, before we get into the nitty-gritty, just a quick reminder. If you like what we do here, please like and subscribe to Stock Analytics AI. For $4.99 a month, members get priority deep dives. We're actually planning to cover the whole S&P 500 over the next few months, and members get first dibs.
And if you just want a one-off analysis on a specific ticker, dropping us a super thanks is the way to go.
Perfect.
So for today's analysis, again, it's Trimble Inc., TRMB. We're looking at it as of September 20th, 2025, and the closing price that day was $82.78.
All right, let's start unpacking this transformation. Chapter 1, Business Analysis. The digital physical nexus.
Okay, so Trimble's whole identity, it's really changing. It's driven by the strategy they call Connect and Scale 2025. Basically, they're not just selling like GPS gear anymore.
Right, they're selling outcomes, workflow integration.
Exactly. They've moved from, hardware tools to these big software platforms that manage a company's entire operation. It's a huge shift.
And you can actually see that shift in the numbers, can't you? The quality of the revenue looks totally different now.
Totally. That predictable, high-margin, recurring revenue, it's now 63% of their total revenue. And software and services together make up almost 80%, 79% of the top line.
So it looks much more like a software business profile now, not some old-school industrial firm.
That's the idea. And the scale they're operating at, that's what gets people excited. Take their biggest segment, AET, that's architecture, engineering, construction, and owner-operated.
Right.
Their platforms, things like SketchUp, Tekla, and especially the big integrated one, Trimble Construction One, they're managing over $500 billion in new construction project value every year.
Okay, $500 billion. That sounds enormous.
Yeah.
But is that just like a big number they throw out?
Yeah.
Does managing the data automatically mean customers stick around? Couldn't someone else just build connections and offer cheaper software?
That's a fair challenge. And look, the $500 billion matters because it shows how deeply they're embedded. Once a construction firm is running its billing, its inventory, its crews, even its autonomous machines through Trimble Construction One, switching becomes a massive headache. You're not just swapping out one tool, you're fundamentally rebuilding how your business operates, especially in these industries where margins are already tight.
So that integration creates really high switching costs. That's the moat.
That's moat number one, yeah. But the second piece, this proprietary data thing, that could be even bigger down the road.
Tell me more about that.
Well, think about it. They've had sensors out on millions of construction sites, farms, trucks, for decades. They've collected this enormous, unique pool of data about how things work in the real world.
Data that, Google doesn't have.
Exactly. Generic AI can't get this level of specific contextual detail. So Trimble's AI might be able to predict when a specific tractor part will fail based on sensor data from thousands of similar tractors in similar conditions. A generic model just can't do that.
Okay, so that data fuels industry-specific AI that's actually defensible because nobody else has the raw ingredients.
Precisely. It's a unique asset. Chapter 2, Management Evaluation, Stewardship and Strategy.
All right, let's shift from the business itself to the management. The CEO, Rob Painter, he's seen as the main driver behind this connect and scale strategy, right?
He is, yeah. And strategically, he seems to be making some smart moves. They've sold off bits that don't fit, like some telematics stuff, and they did that big joint venture in agriculture with AGCO. It looks like they're really trying to focus on the higher growth software parts.
That focus seems sensible, but, and it seems like a pretty big but, there's this major issue with their governance, isn't there?
There is. And it's serious. Trimble's gotten these deficiency notices from NASDAQ repeatedly through 2024 and into 2025 because they keep filing the required SEC reports late.
Okay, that sounds bad. That's not just a paperwork delay, is it? What does that actually mean for investors?
Well, it raises real questions about their internal financial controls. Are they robust? Are they complying properly with regulations like Sarbanes-Oxley? It makes auditors more skeptical, probably increases costs for reviews, and it definitely distracts management.
Yeah, you want a company focused on precision technology to be, well, precise with its financials too. It feels like a disconnect.
It's a definite red flag, and it gets even more complicated when you look at how they're spending money. On one hand, the company's been buying back a lot of its own stock.
How much are we talking?
About $677 million just year to date in 2025. That's a huge buyback program. Usually signals management thinks the stock is cheap.
Okay, but
Yeah.
how does that square with their actual track record of investing capital?
Well, that's the contradiction. Their actual historical return on invested capital, the ROIC, is frankly pretty weak. It's sitting at about 5.27%.
5.27%.
Yeah.
And what's their cost of capital roughly?
We estimate their WACC weighted average cost of capital is around 13.62%. That's likely higher because of debt from big acquisitions like Transporon, but still.
Whoa. So ROIC is way below WACC. That means their recent investments haven't actually created economic value yet.
That's what the numbers imply, yes. They need to significantly improve how effectively they deploy capital for this whole transformation to really pay off for shareholders. That gap is concerning.
Chapter 3, Financial Analysis, the Quantitative Blueprint.
Moving to the financials themselves, you hit this sort of paradox with revenue. If you just glance at the top line, total revenue looks kind of flat, around $3.7 billion in 2024, maybe even down a bit year over year.
Which normally you'd think, okay, this industrial company isn't growing.
Right, but when you dig just one layer deeper, the picture changes completely. The quality of that revenue, the underlying health, it looks really strong.
Oh, so yeah.
Their organic annual recurring revenue, ARR, that's the key subscription metric, it grew 14% in the second quarter of 2025. That's impressive growth.
Oh, okay. So they're swapping out lower margin hardware sales for higher margin recurring software revenue. The total might be flat for now, but the core high quality part is growing nicely.
Exactly. It perfectly illustrates the pivot in action, and you see it drop to the bottom line too.
Standards of profitability.
Yeah. Because they're focusing on software, their non-GAAP gross margin just hit a record high 70.6%. That's undeniably a software level margin. It really backs up the story that the business model itself is fundamentally improving.
Okay, let's talk about something else that might jump out at someone looking at the balance sheet, the current ratio. It's low, right? Like 0.94. Doesn't that usually signal a liquidity problem?
Normally, yes. But for a successful SaaS business, it's often the opposite. It's actually a feature, not a bug.
How does that work?
Well, when customers pay upfront for a year's software subscription, Trimble collects the cash but hasn't earned all the revenue yet. So they book that cash as deferred revenue, which sits on the balance sheet as a current liability.
Ah, so the liability goes up, pushing the current ratio down, even though they have the cash.
Precisely. It essentially means customers are financing the business. It's called negative working capital. It's actually a sign of financial strength in this model, not weakness.
Got it. That's a key distinction. So finally, valuation. How does it stack up?
Well, if you look at the trailing gap PE ratio, it looks really high, maybe around 70x, but that's often distorted by things like acquisition-related amortization.
So what's a better measure?
If you look at the forward PE, based on non-GAAP earnings estimates, it's around 27.7x.
And how does that compare?
That 27.7x, well, it's way more expensive than traditional industrial companies like Caterpillar or Deere. But if you compare it to other engineering software companies like Autodesk or PTC, it's actually right in line.
Interesting. So the market is clearly pricing it as a software company that's already made the transition, basically buying into the bull case.
It seems that way, yes. The valuation reflects that expectation of continued high-quality growth. Chapter 4, Market Sentiment.
Okay, so what does Wall Street think overall? Are analysts buying this story?
Overwhelmingly, yes. The consensus is pretty much all buy or strong buy ratings. Price targets generally suggest maybe 10% to 17% upside from where it is now.
So targets somewhere in the $90 to $97 range, give or take.
Yeah, roughly $90.75 to $97.21 is the range we saw. So analysts are clearly optimistic that the company can execute.
And what about the technicals? Does the stock chart look positive?
It does. The price, $82.78, is trading pretty comfortably above both its 50-day and its 200-day moving averages. That usually indicates solid bullish momentum, both short-term and longer-term.
Chapter 5. Ownership structure. Who controls Trimble?
In terms of who owns the stock, it's almost all big institutions. About 98.6% is held by funds.
Wow, that's high. Mostly index funds.
A lot of it, yeah. Vanguard and BlackRock are the top holders, which you often see with large cap stocks. It provides a pretty stable base of ownership.
Okay, but didn't we touch on something a bit contradictory earlier regarding insiders? The company is buying back stock, but what are the executives doing?
Right, and this is where it gets a bit murky, perhaps. While the company is spending hundreds of millions buying back shares, signaling confidence, top insiders, and that includes CEO Rob Painter, have been consistently selling shares throughout 2025. These look like automated pre-planned sales.
Automated or not, they're still selling. And are any insiders buying on the open market?
Nope. We saw 0 open market purchases by insiders during this period.
So how do you interpret that? Management says these sales are planned for diversification or taxes.
And that's often true. They use these 10b5-1 plans. But, you know, optics matter. When the company is loudly proclaiming confidence with massive buybacks, but the top brass is consistently selling and not buying a single share on the open market.
Yeah, it sends a mixed message, doesn't it? It suggests maybe their personal conviction about the stock's value at these levels isn't quite aligned with the corporate action.
It definitely creates a potential misalignment narrative for investors to consider. Chapter 6, Risk Assessment, Acknowledging the Headwinds.
Okay, let's try and pull the key risks together. Internally, what are the biggest wake spots we identified?
I'd say the 2 critical ones are, first, those serious governance lapses, the repeated SEC filing delays. That's a fundamental problem.
Right.
And second, that lagging return on invested capital. The fact that ROIC is still below their cost of capital is a major financial headwind. They have to improve investment returns.
But then you balance that against the opportunities, which seem pretty significant too.
Absolutely. On the opportunity side, you've got this huge $72 billion addressable market construction, agriculture, logistics that's still relatively early in its digital transformation.
So a long runway for growth.
A potentially very long runway, yeah. Plus, that whole idea of monetizing their unique data through specific AI models, that could be a massive kicker, though it's still early days.
Okay, internal risks, secular opportunities. What about external threats? The macro environment.
That's definitely a key risk right now. Rising inflation is one thing, but persistently higher interest rates really hit Trimble's customers hard.
Because they're customers' construction firms, farmers borrow money for big purchases.
Exactly. Higher borrowing costs make them put off buying expensive, heavy equipment. And critically, it also makes them delay investing in new technology platforms, even platforms like Trimble's that promise efficiency.
So a tough economy directly slows down Trimble's sales cycle, both hardware and potentially software adoption too.
It absolutely can, yes. That's a significant near to medium-term threat.
Chapter 7.
All right, so boiling it all down, the bull case for Trimble really rests on them successfully making this pivot to software. You've got that strong 14% recurring revenue growth. You've got the data moat building up, and these big long-term trends like digitization supporting them.
Makes sense. But the bear case is pretty compelling too. You've got the governance mess potentially distracting them. Total revenue hasn't actually grown much yet. The valuation is already pricing in a lot of success.
And that ROIC number still lags significantly behind the cost of capital, meaning execution hasn't quite matched the strategy yet.
Right. So when you put all that into a valuation model, like a discounted cash flow analysis, where does the intrinsic value roughly land?
Our analysis suggests a range somewhere between $75 and $85 per share for intrinsic value.
Okay, and the stock is currently trading right around $82, $83.
$82.78 was the price we used.
So smack bang in the middle of that estimated fair value range.
Pretty much, yeah. The final verdict seems to be that the market is actually doing a decent job here. It's balancing the obvious potential from the software shift against these very real risks around execution, governance, and the economy.
Meaning there's no obvious big discount, no significant margin of safety at today's price.
That's how it looks to us right now based on the data as of September 20th, 2025. But just as a final thought to leave you with, consider that unique data asset again. What if AI adoption in these big physical industries, construction, agriculture, happens much, much faster than our traditional models predict? If that happens, Trimble could unlock that super high margin AI-driven revenue stream way earlier than anyone expects. And that could fundamentally change the whole valuation picture, potentially very quickly.
That's a really interesting point to ponder. How fast can these old school industries really digitize? Food for thought. Well, thank you for walking us through all that on Trimble. And thanks to all of you for joining us. Remember to like and subscribe to Stock Analytics AI. For €499 a month, members get priority access to our deep dives, including our ongoing S&P 500 coverage. And a super thanks gets you a one-off dive on the ticker of your choice. Just a reminder, this analysis was generated by an AI system for educational purposes only. It is definitely not financial advice. Always do your own research or talk to a qualified financial advisor before making any investment decisions.